This is UiPath on the weekly chart, and you can see that price did form a double bottom back in late 2022. Double bottom is a bullish reversal pattern. You could also see that price action also formed what I like to see is a W pattern, also a bullish reversal pattern. And typically when price breaks the apex of the W and retest, that is a good level to go long. En route of forming this W pattern, price formed a weekly bias level at 1350. Price came back, penetrated the zone more than 50% and got a bounce. However, this bounce could not take out the pivot high to the left. So when price came back, it penetrated the and closed slightly below the bottom of the zone before finding buyers and pulling back again. Price came back, dipped its toes in the upper range of the zone, and is now bouncing higher. So we know that this is a strong level where buyers are willing to protect the level from sellers. Question is, based on what I just said, are you bullish or are you still bearish on UiPath? Before we continue with the analysis, let's look at this article. It is coming from the Motley Fool. UiPath stock, bear versus bull. So they recently announced their second quarter earnings. The automation software company's revenues rose 19% year over year, which topped analyst estimates by 5 million. The headline of the report, well, regarding the price action, it still remains 70% below its IPO price. So UiPath revenue soared 81% in fiscal 2021 and grew another 47% in fiscal 2022. However, its revenue only rose 19% in fiscal 2023 as the macro headwinds drove companies to rein in their software spending, a la interest rate hikes. Oh, it says it. Along with rising interest rates, which cast a harsh light on its frothy valuation and lack of profits, that drove the bulls away. That drove the buyers away. However, UiPath's gross profits continued to rise in the second quarter as revenue grew faster than its total cost of revenue. All right, so what's the case that the bulls are making? Again, revenue grew 20% to 21% in fiscal 2024, which was an acceleration from the previous fiscal year. The sunny outlook suggests UiPath's slowdown was caused by cyclical headwinds instead of existential ones, and that it should continue to expand at a healthy clip as the macro economic environment improves. So we are near the end of the interest rates cycle, not only in the U.S. but worldwide. UiPath's margins are also expanding as its revenue growth stabilizes. In the first half of 2024, its adjusted gross margins rose year over year from 85 to 87%, as its adjusted operating margin improved from negative 5% to positive 14%. That expansion suggests it still has pricing power and that its cost-cutting measures are paying off. Let's talk about the free cash flow. They generated 119 million in the first half of the fiscal 2024 compared to a negative adjusted free cash flow of 77 million in the first half of fiscal 2023. To put that cash to work, UiPath launched a new 500 million buyback plan, which will expire in March of 2025, implying its own shares are currently undervalued. That's pretty key. When the company is going to buy back shares, as they think the stock price is undervalued. All right, so what is the case for the bears? Well, Year-over-year revenue growth per existing customer is declining. That metric came in at 121% in the second quarter, compared to 122% in the previous quarter and 132% a year ago. UiPath's declining retention rate also coincides with the rise of generative AI platforms like OpenAI's ChatGPT. UiPath insists it can use generative AI algorithms to upgrade its own software robots, but there's also a chance that large companies will simply start automating their own tasks with generative AI tools instead of relying on UiPath. UiPath still has a lot to improve, but I believe its strengths outweigh its weaknesses. This is the article, not me. I'm just a technical analysis guy. Its stock is cheap. Its near-term outlook is stable. Its retention rates suggest it can still keep pace with the broader RPA market, and its first mover advantage and low enterprise value could make it a compelling takeover target for tech giants like Microsoft or Salesforce. Okay, now you're talking. Takeover candidate. All right, so getting back to the weekly chart. Again, you got a patch of sellers between $18 and $20. But even when you get above this level here, you're going to run into this support resistance band at $22. So to me, the upside is limited in the short term. Down at the $13, $14, that was the best level to get long. Let's look at this just on a daily chart. Yeah, so you got to get past this pivot high over here, which was the origin of the leg down. As you can see, price is selling off from hitting its high for the day thus far. Yeah, I would not recommend getting in. Ideally, what you want to see for conservative investors you want to see price take out that $22 resistance support band, retest it, and then move higher. You know, midterm, longer term price target at 30. There's just too much headwind at the moment. The opportunity was lower at the weekly bias level at 13.50. Thanks for watching. Subscribe. Please like the video.